So if you've been watching the Break Into CRE YouTube channel for a while now, you know that our main focus is on commercial real estate career advice and investment analysis techniques to help you make better investment decisions. However, over the last 2 years of running this channel, I've also learned that many of you watching and looking for career advice to break into the industry also have your own long-term goals to ultimately make your own direct investments in commercial real estate deals, even if you plan to land a job in the industry first just to learn the ropes. And this is the camp I fell into when I first started out in the industry, looking to get paid to learn the best practices of commercial real estate investing from the best investors in the business, and to ultimately use those same practices in my own deals in the future. And with next year marking my 10th year in the real estate business, I've had some time now to make quite a few of my own investment decisions, some of which have turned out well and others which have turned out not so well. But even in those downside scenarios, each of these situations was able to teach me a valuable lesson about how to make better real estate investment decisions in the future. And if you're just starting out in the real estate industry and looking to build your own portfolio, in this video, I wanted to share some of the biggest lessons I've learned throughout investing in commercial real estate over the past decade and the common threads between my best and worst investment making decisions that you might be able to learn from and apply to your own real estate investment decisions going forward. So every investor gets into real estate for different reasons, and for me, I've always liked the idea of creating better places for people to live, work, and shop, and the tax benefits and opportunities to generate cash flow in commercial real estate are just really hard to beat in many other investment vehicles, especially on a risk-adjusted basis. However, just like everyone else, I've also had my fair share of missteps throughout my real estate investing career, even with years of experience at major institutional real estate private equity firms under my belt. And however annoying, costly, or careless these mistakes were, these decisions have also taught me some really important lessons to help me make better decisions in the future that I think you might find helpful if you're looking to build your own real estate portfolio today. So as far as specific lessons learned, let's start this off with lesson number one, and that is that no matter what, it is incredibly important to stick to your core investment criteria. I talk a lot on this channel about investing with your own personal goals and objectives in mind, and this is really me speaking to a younger version of myself from personal experience. In deals I invest in, I'm primarily looking for moderate to high cash-on-cash returns, longer-term hold periods, and deals in markets which have solid demographics and net migration patterns that signal population growth in the area in the future. Many people would describe my kind of investing as setting out to hit a bunch of singles and doubles consistently over time rather than trying to hit a few home runs here and there, and this is how I've experienced the most success when I look back at deals that have gone well and the ones that haven't. But with that said, some of the biggest real estate investment mistakes I've made have also come from decisions that have deviated from this path, where I've chosen to invest in a deal where maybe the cash-on-cash return was delayed or speculative based on uncertain future events, or the deal was planned to be sold in just 2 to 3 years without a long-term hold strategy to generate cash flow, or the deal lacked diversity in its tenant base, exposing the property to major cash flow fluctuations based on the occupancy of just 1 or 2 suites. What I've learned through these experiences is to be patient and to wait for deals that do fit my criteria rather than scrambling to make a deal work, because it sounds like the potential upside could be worth it in the future. And I've also learned to make sure I'm not making investment decisions out of fear that another opportunity this good might not come along in the future. Deals with a high cash-on-cash return at the time of acquisition, even if I'm sacrificing a little bit of long-term upside, deals with long-term hold horizons with an IRR projection in the low teens, or a deal with significant tenant diversity but no home run potential have all been the profiles of deals that have worked out the best for me throughout my investing career, and these are the types of projects I've come to be most excited about at this stage of the game. For anyone watching this who has ever played baseball, I like to think about this as waiting for your pitch. If you only swing on deals that you know are in your sweet spot, even if you start your at-bat feeling like you're behind in the count, your overall performance is going to be significantly better than if you swung at everything that was even remotely close to the strike zone. Now, lesson number two I've learned over the last 10 years is actually directly related to this, and that is that if you have to stretch your investment criteria to make a deal work, you probably shouldn't be investing in that deal in the first place. If you're investing in a single tenant commercial deal with the promise of a lease being signed shortly after closing that will generate double-digit cash on cash returns, be prepared to have that tenant back out at the 11th hour, leaving the property vacant for another 6 months or more while debt service eats away at cash reserves. And if you invest in ground leases to generate higher cash on cash yields, be prepared to have additional cash flow strains on the partnership when tenants do vacate, and make sure you're ready to accept a lower sale value as the maturity of the ground lease gets closer and the next buyer risks losing those improvements back to the landowner. And if you invest in a multi-property portfolio with one of those portfolio deals being a ground-up development project, be prepared for that investment to generate low or non-existent cash flow distributions for at least 2 to 3 years after your initial investment in the project, and also be prepared in case that cash flow doesn't ever end up materializing. These are all examples of things that I've come across in my own investment career, and ultimately each of these issues have come up when I've gotten greedy on deals or when I've had a scarcity mindset around investing, not knowing when the next deal will come around and jumping into something just because it was available and the best option at the time. The deals I've been happiest that I've invested in are the deals that I know will perform from day one based on historical and in-place operations, or projects that have a proven value-add business plan that has already been partially implemented by the seller, and it's just a matter of executing a boring but predictable strategy to raise rents or reduce expenses gradually over time. Similar to a point I made in my last video, I've learned that if an investment opportunity sounds too good to be true, it probably is, and my experience has taught me that this tends to be the case. And finally, the third lesson I've learned after a decade in the industry is that when investing in deals as a passive limited partner, who you partner with is just as important as the deal your partnership decides to buy. Individual sponsors and real estate private equity firms can operate extremely differently from one another, and with that, you want to go into any deal understanding exactly how that sponsor plans to operate the deal and how that sponsor plans to communicate with investors. I've invested in deals where the sponsor sent out only 3 investment updates during a 2-year hold period, each at random different times of the year when quarterly reports were promised when the property was first acquired. I've also invested in deals with incredibly aggressive fee structures, but since these were early investments in my career, without the context of how these fee and waterfall structures compared to other options, I was blissfully unaware of the haircut I'd be taking on returns, ultimately for years down the road. Some sponsors I've invested with have always sent out K-1s on time, making tax returns quick and painless, while others have to be tracked down in early April every single year, often making tax time a nightmare or at least a hectic sprint to get everything completed on time. Real estate is a very illiquid asset class, meaning you can't necessarily sell your shares in a property the minute you decide that you want to get out. And if you end up in a deal with partners that aren't the right fit, there often, unfortunately, isn't much you can do about this, and I found this out the hard way through several deals I've been in for 5 years or more that at this point have resulted in more headaches than cash flow to me, and if I could go back and do it all over again, I probably wouldn't have invested in these deals in the first place. At the end of the day, it's hard to shortcut experience, and you'll inevitably pick up some of your own bumps and bruises along the way as you're making your own investment decisions throughout your commercial real estate career. But with that said, as is the goal with all of these videos on this channel and in the Break Into CRE coursework, I hope my experience can at least help you accelerate your own learning curve in the industry and can help you be on the lookout early for some of the things I had to learn the hard way in my own commercial real estate investing career. And if you are looking to make your own real estate investments, either as an active investor or as a passive investor, and want to learn more about how to analyze the deals that are being presented to you, make sure to check out our all-in-one membership training platform, Break Into CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get instant access to our entire library of pre-built acquisition, development, and waterfall models for multifamily, office, retail, and industrial properties. And you'll also have access to private one-on-one email-based career coaching if you're looking to break into the industry for the first time and looking for some additional personalized feedback on your own unique career scenario and what steps might be best for you to take next. And if you like this video and want to see more content on this channel like this, make sure to hit the like button to let me know, and let me know in the comments some of the best and worst real estate investment decisions you've made and what you've learned throughout the process. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.